everybody, and welcome back to my channel. Today we are going to be talking about IDRs, or Income-Driven Repayment Plans. Now, the government, for some reason, likes to make this a little bit complicated, but I promise it's really not that complicated, and there is bound to be a program that's going to make things better for you. So let's get right into it. I'm Melissa Ford. Welcome to Damsel of Success, where we talk about all things money. Please be sure to like and subscribe and hit the bell to be notified when I post a new video. So today, like I said, we're going to be talking about IDRs, or Income-Driven Repayment Plans. This is a kind of plan that the government has put together to help make your student loans more affordable to pay off. And the first thing that you need to know about IDRs is what they're not. So this isn't forbearance or deferment, which are temporary programs to help you, not have to make payments for a little while. This is a long-term payment plan that typically ranges between 20 and 25 years. This is also not a loan rehabilitation program, which is different. That is something that you would use if you were in default on your student loans to get you back into good standing. That's not what this is. So like I said, IDR stands for Income-Driven Repayment, and it's not an actual repayment loan in itself. It stands for a group of different options that you can choose from to repay your student loans in a different way than the standard way. And what's great about an IDR is that it can make your payment plan more affordable than it is right now. And it does that by stretching out the length of the loan so that you're paying a little bit less. So there are 4 different IDR options, and those 4 options differ in 2 factors. Number 1 is how much of your income they say it's appropriate for you to pay on them. And number 2, how long the repayment term is. The 4 options are: number 1, the pay plan. The pay plan bases your payback amount on 10% of your discretionary income, and it lists a 20-year repayment timeline. The repay plan is very similar. It also lists your payback terms as 10% of your discretionary income, and it's a 20-year repayment plan. The IDR loan is a little bit different than those two in that your payment amount is based on your discretionary income from 10 to 15%. It's going to be one or the other, and that depends on what you qualify for under the eligibility terms, which we'll get into a little bit later. This plan is also a 20 to 25 year repayment plan. And last, and frankly least, is an ICR program, which lists your percentage of payment as 20% of your discretionary income, and it has other qualifications too. And also, the payback period on this is 25 years. So why would you consider one of these IDR repayment plans? Number 1, they're going to make your payment smaller. If you are in a position where the payment that you're paying for your student loans is just overwhelming, or it feels like too much, or it's just taking up too much of your budget and you're struggling to repay it, then this is the time for you to consider one of these IDR plans. Number 2, and this is the biggest thing, is that once you're finished with that 20 or 25 year amount, the remaining amount of your student loans are forgiven. That means that if you're continuously paying that income-driven repayment plan, that at the end of 20 or 25 years, depending on the plan, that your loan amount will be completely forgiven. Now, there is a little caveat on that. And so you'll be responsible for paying taxes on that amount. So for instance, if your forgiven amount is $10,000 and you are in a tax bracket where you're paying 25% of your income as tax, then you would be responsible for paying that year $2,500 in tax. And while that tax bill isn't super fun to deal with, it is a lot more fun than paying that total amount of $10,000. So what are some of the downsides of an IDR plan? Why would you maybe not want to consider it? Well, first of all, you'll be paying on that loan a lot longer. Where a standard loan is 10 to 12 years, with an IDR, the payment period is going to be 20 to 25 years. So you're going to be paying that a lot longer than you would a traditional student loan. Second is that you'll likely pay a lot more total because over those years, interest has a lot more time to accrue. And so because of that, you'll likely be paying more in interest to pay off that loan. The third thing that is a little little bit of a downside about this is that you have to really pay attention to this. It is a program where you have to reapply for the program every single year, and that reapplication adjusts your payment amount based on what you're making. And that can be a little bit of a hassle. Fourth is that with the average student loan amount, you're probably going to pay this off before the end of the term. And so it's highly unlikely that you'll actually have any amount to be forgiven in the loan. And fifth is that little tax thing like we already talked about. Any amount that is forgiven would be added to your taxable income for that year. So the next thing that you need to be aware of in an IDR is whether you're actually eligible for one. For every single one of those 4 options, it has to meet 2 eligibility requirements. Number 1 is that it has to be a federally backed student loan. Private loans do not qualify for an IDR. Second is that you cannot currently be in default on your student loans. In order to become eligible for these programs, you would first have to go through a loan rehabilitation program. In addition to those 2 requirements, each plan has additional requirements that you have to meet in order to be eligible. Now, some of these eligibility requirements have terms associated with them. So let's go through some of the basic terms that are used when looking at eligibility. Number 1 is new borrower. So to be considered a new borrower, you cannot owe any money on a federal student loan before the date of October 1st, 2007. And you have to have received a disbursement for a direct student loan on or after October 1st, 2011. That is what defines a new borrower. Another term that is often used to qualify for these loans is partial financial hardship. And what that means is that your current student loan payment is greater than the 10% to 15% of your discretionary income that your new student loan would be based off of. The third term that is used in determining eligibility is discretionary income. How is that figured? Discretionary income for 3 out of the 4 loans is figured as your AGI, or adjusted gross income, minus 150% of the federal poverty line for the state that you live in. Only one of the student loans, the ICR loan, has a different definition for discretionary income. It calculates your discretionary income as your AGI minus 100% of the federal poverty line for your state. So like I said, each of the 4 plans has different eligibility requirements. And I'm going to do some videos in the future on each of these repayment plans to really dive deep in what you need to know about every single one. But as a brief overview, let's take a look at this chart in terms of eligibility. So the pay loan is only eligible for new borrowers. You must demonstrate partial financial hardship, and the only eligible loan types are direct loans, unless they're consolidated, in which case FFEL loans would also be eligible. The repay loan is eligible to all types of borrowers. You do not need to demonstrate partial financial hardship. Eligible loan types like the pay loan are only for direct loans, but if consolidated, it will also allow you to include FFEL loans and federal Perkins loans. An IDR loan is eligible to all borrowers. However, if you are a new borrower, your terms or your payment amount is lower. A new borrower would qualify for a 10% of discretionary income repayment plan, whereas someone who does not qualify as a new borrower would be at 15%. You must demonstrate partial financial hardship. The eligible loan types are direct loans and FFEL loans. And if it's consolidated, a federal Perkins loan would also be eligible. An ICR plan is eligible for all borrowers. You do not need to demonstrate partial financial hardship. It is eligible for direct loans and direct consolidation loans that did not repay any plus loans made to parents. And if the loan is consolidated, you are also eligible for an ICR loan if you have a direct plus loan that is made to parents, or an FFEL loan. Now, you might have noticed that if you have a Federal Plus loan that has been made to parents, the only plan that's available to you is an ICR loan. And frankly, that's the only time that I would recommend an ICR loan be used, because the terms are just a lot more difficult. It's based on 20% of your discretionary income, and that discretionary income is defined as 100% of the federal poverty line instead of 150%. So the ICR loan is only really a good option if you have a Federal Plus loan that has been made to parents. So probably the biggest thing that you want to know is how much you're going to actually have to pay for one of these loans every month. I'm going to put a formula here up on the screen so you can see how your payment will be calculated. So first of all, you're going to take your AGI, or adjusted gross income. So you're going to take the balance of that federal poverty line number and you're going to subtract it from your AGI. Then you're going to take that balance that you get and multiply it by either 10, 15, or 20% based on your IDR plan, divide it by 12, and that will give you your monthly payment. So in order to calculate this for yourself, you're going to need your AGI, the federal poverty line in your state, and the payment percentage of your plan. The first thing that you're going to need is your AGI, or adjusted gross income. So for 2020, your AGI is located on page 1, line 11 of your 1040 tax return. And that's something that you can just pull from your tax return as the amount of taxable income. So that takes into account things like your health expenses that are deducted from your paycheck, your taxes that are deducted from your paycheck, and any 401k, contributions that you're making, or retirement plan contributions that you're making pre-tax. Whatever that number is, that is considered your AGI. Next, you got to look up the federal poverty line. So the federal poverty line, and this was a little bit surprising to me, is actually the same for every state except for Alaska and Hawaii. I'm going to put up a chart here so that you can see what that federal poverty line looks like. So for a single individual in every state except for Alaska and Hawaii, the federal poverty line is $12,760. I honestly cannot think of a place in the United States where anyone could actually survive on that amount every year. That is what the federal government has listed as the federal poverty line, and so that is the number that we have to use for this calculation. So let's go through a real world example so you can kind of see how this formula might be applied to you. For this example, I'm going to make a couple of assumptions here. So number one, I'm going to assume that you are single and that your family size is 1. Second, I'm going to assume that you live in the United States but don't live in Alaska or Hawaii. Next, I'm going to say that your AGI is $40,000, that you have $45,000 in eligible federal student loan debt, and so your federal poverty line would be $12,760. Next, I'm going to say that you have been selected for and qualified for the PAY program, which has a 10% payment amount. So first, we're going to calculate your discretionary income. For the PAY program, that's considered 150% of the poverty line. So that number, we would take that 12,760 number, multiply it by 150%, and you would get $19,140. Then we would take your AGI and subtract that amount from your AGI. So if we take the difference between your AGI and 150% of the poverty guideline amount, that would be $20,860. That is what your discretionary income would be under the PAY program. So then what we're going to do is take that $20,860, multiply it by 10%, which would give you $2,086. That is the amount that you would have to pay for an entire year for your loan under the PAY program. And so if we take that $2,086 and divide it by 12, that would give you $173.83 would be your monthly payment under the PAY program. And if you compare that amount to a standard student loan for $45,000 at a 6% interest rate under a 10-year repayment plan, then you would have actually been paying $500 a month for that. Under the PAY program, you would be paying significantly less per month for that student loan. So we just calculated what your monthly payment would be under the pay program. I'm going to put up a chart here that shows what it would be under the other programs under the exact same circumstances. So for the repay loan, it would be identical. It would be $173.83 per month. For an IBR loan at 15%, not that 10% new borrower rate, it would be $260.75. And for the ICR loan, it would be $454. So you can see right away why that ICR loan isn't a great option unless you have a federal plus loan that was paid to parents. Now, the great news that I have for you is that you don't actually have to calculate this on your own. The federal government has put together a loan calculator that you can use to determine which of these loans would give you what kind of payment schedule. And I'm going to put that link for that loan calculator in the description below. So at this point, you might be asking yourself, which of these IDR loans is right for me? It depends on a lot of different factors. So is it more important to you to pay off that loan quickly? Or is it more important to you to have the total amount that you pay on your student loans be as low as possible? Or is it more important to you to reduce that monthly amount as much as possible? Each of these loans could have a different result for all of those categories. And so you've got to kind of try and figure out what's most important to you. So using the exact same parameters as we talked about before, let's look at how each of those 4 options would play out over time. So you can kind of see how the different priority that you have would factor in to choosing the right loan for you. So take a look at this. Now we know under the standard loan, you'd be paying $500 a month for 10 years, and then you'd be completely done with that loan. Under these other 4 repayment programs, there are different parameters. So if your goal was to spend the least amount possible on your student loans, well, then you'd still be sticking with your standard loan, or you'd want an ICR loan because the total amount paid would be $68,503. However, if you wanted a loan that reduced your payment amount to be as small as possible, you'd want to consider either the pay, the repay, or the IBR loan. So if you're looking for a loan that would have you pay off your balance in the shortest possible amount of time, you'd either want to stick to your loan as it is today with a standard loan, or go for the ICR loan, which would be paid off in 14 years under this scenario. So as you can see, it's really all about, number 1, what you're eligible for, and number 2, what your priority is in terms of paying off your student loan. And like I said, the federal government has put together a really great loan calculator so you can kind of see what those terms would be for all of the different loan options that are available to you. And like I said, I will put that link in the description below. So what else do you need to know about these IDR loans? Well, the biggest thing is that you need to recertify these loans every single year. So every year, your loan servicer will contact you to recertify your enrollment in this program. And they'll check on things like your adjusted gross income, as well as your family size, to determine what your new payment amount will be for that year. Like I mentioned before, all of these payment plans are based on your discretionary income. So if your discretionary income changes throughout the year, well, that's something that you would need to have recertified with your loan servicer. Now, the good thing is if those terms change for the better for you, if it's going to lower your payment, you can actually contact your loan servicer at any time to have that loan recertified under the new circumstances that you find yourself under. So if your income goes down or you add an additional family member, all of those things might affect how much you have to pay, and you can change that at any time just by contacting your loan servicer. But the most important thing to know about recertifying is that you must do it every single year. So if you don't recertify your IDR plan, a couple of penalties might be applied to you. Now, these penalties vary by plan, but they could include things like, number 1, your payment could go up to your standard repayment plan rate. So instead of whatever that $173 payment amount that we calculated earlier, if you don't recertify, that could go up to that $500 repayment amount without you even knowing it. Second, your interest may capitalize on the loan. Now, that's a little bit complicated and I won't go too into the weeds here, but essentially what that means is that if you're paying an amount that doesn't cover the interest for your loan, so let's say you're paying that $174 amount, but the amount of interest that you're paying in that payment is actually $300 a month, well, that leftover amount of money that you're not paying towards that interest. So the way these IDR loans are structured is that you don't have to worry about that. But if you fail to recertify, that loan interest will be capitalized. So you'll be paying interest on your interest, which is no good. You don't want that. Another penalty that they might assess is that they would automatically push your status back to single, even if you had dependents. So if you have kids, if you have a couple of kids, that is actually reducing your total amount that you have to pay every month. And so your payment would go up. And obviously you don't want that to happen. That's why you're on one of these IDR plans to begin with, is so that you can have a more manageable payment amount for your student loans. So just be careful and make sure that you recertify that loan every single year. And like I said, your loan servicer will reach out to you every year to make sure to remind you to do that. So we've talked about what an IDR is and the different kind of options that might be available to you in terms of IDR loans. So you might be asking at this point, well, how do I get an IDR loan? Well, it's actually really simple. All you have to do is reach out to your current loan servicer. So whoever it is that you're making payments to right now, all you need to do is reach out to them and ask to be considered for an IDR plan. And they will take you through the steps that you need to complete in order to qualify. That's it. So hopefully this video has given you the information that you're looking for about what IDR loans are and how you can use them to help you reduce that student loan payment so that you're paying a little bit less on your student loans every single month, which hopefully in turn helps you reach your financial goals. And if that's something that's important to you, if you're, kind of all about reaching those personal financial goals and you're into personal finance, then I hope you will give some of my other videos a watch, because that is everything that my channel is about. We talk about investing, we talk about personal finance, we talk about loan repay off and debt repay off. I would love for you to, take a look at some of my other videos and hopefully be there to help you on your financial journey. So if you have debt that you're looking at paying off, including student loan debt, then I have a tool that would help you. It's a debt payoff tracker. And what that allows you to do is take a look at all of the debts that you need to pay off and help you prioritize when and how to pay off those debts. And I'm going to put a link where you can download that for free in the description below. So feel free to check it out if that's something that you think could help you. So that's all for now. Have a wonderful week. Bye-bye.